Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Welcome to Supernatural Stocks right here at the end of the year now. Thank you for being here and making time for this in your holiday period. Now, JSE-focused investors, they just love using the PE ratio, don't they? It's the primary valuation metric for our listed companies. Now, this may well be because of all the tight rules around headline earnings per share, which govern what can and cannot be adjusted in that disclosure. In the US, for example, although companies do need to report what they call GAAP earnings, so that's generally accepted accounting practice earnings, and there are lots of rules attached to them, the market always seems to focus instead on adjusted EBITDA, and some of those adjustments are just nonsense, let's be honest. Stuff like reversing out stock-based compensation to employees is a perfect example. You cannot just pretend that diluting shareholders over time in order to reward staff isn't an actual expense, yet US tech companies especially try to do that all the time. Now, in South Africa, we don't really see all too much of that, I must say. Headline earnings per share in South Africa is a way more reliable and consistent metric than adjusted EBITDA in the US. When local companies suggest that shareholders should use adjusted HEPS, it is generally for good reasons. Now, occasionally you do see companies taking a chance, like suggesting that a large credit loss should simply be ignored. Those are business as usual risks in my opinion, and whilst they are hopefully non-recurring in nature, they also shouldn't be glossed over because they are just part of doing business. But for the most part, we do not see much nonsense in this regard on the local market. A good example of valid adjustments can be found in the recent We Buy Cars numbers. For the year ended September, headline earnings per share, or HEPS, as reported, was 91.7 cents. At the current share price of $45, this puts the company on a PE of almost 50. Now that sounds crazy, and it would be crazy if it were true. The company also discloses core headline earnings per share, and that's much higher. That's at 217.4 cents. That would imply a price earnings multiple of 20.7, which is still high, don't get me wrong, but it certainly seems a lot more reasonable, doesn't it? So the question is, should the adjusted HEPS number be used, the core HEPS number as they call it, or are these adjustments nonsense? Now, the good news for We Buy Cars shareholders like me is that these adjustments are valid. The company just went through a listing, which means there were huge once-off transaction costs. They had substantial accounting movements as well based on call option derivative assets related to certain shareholders, and that shareholding structure changed as a result of the listing. Now, none of this whatsoever is reflective of the money that We Buy Cars makes from its core business of buying and selling cars. Core headline earnings per share, the way they disclose it, captures the underlying business, and that's the focus for me, and it seems to be the focus for the market as well. So, if you're going to use the PE ratio like everyone else seems to do in South Africa, then at least make sure you're looking at the right E. Otherwise, it is worse than useless. 99 times out of 100, you can just use HEPS, and you can just take the price earnings multiple off any of the trading systems out there, which give you an automatic number based on a data feed. But occasionally, you need to look at adjustments, and those data feeds do not take those adjustments into account. You also need to know when it is not appropriate to look at PE ratios. Just one very good example is property funds. When it comes to real estate investment trusts or REITs, it's all about the dividend yield. Admittedly, that's not hugely different to the inverse of the PE multiple because those funds are paying most of their earnings out as a dividend, but it's still not exactly the same thing. Speaking of the inverse of the PE, it's now time to look at the earnings yield, which is perhaps an easier way to understand what a PE multiple is actually trying to tell you. If a stock is trading on a PE of 10x and it doesn't grow at all, then the earnings yield to shareholders is 10%, which is the inverse of the PE, and that's also the return that shareholders will get because there's no growth. If the dividend payout ratio is, say, 40%, which is quite common, then the dividend yield itself would be 4%, and the remaining cash would be reinvested in the business. Of course, you would have to ask some quite tough questions about this cash being reinvested is not somehow generating growth as well. But be that as it may, this is why they say cash is kin, and you have to be quite careful just using a PE and saying the earnings yield is 10% and that would be my return. Well, if you never get any growth and you only ever get the dividends, then actually the dividends are your return. Now, let's assume you do get a 10% return there. It may well be ahead of inflation, but it's still not a great equity return at all. This is because in South Africa, you can get 8.85% right now on a 10-year government bond, which is considered the closest thing you'll get in this country to a risk-free return. Now, earning only slightly more than that is not great, so stocks trading on a PE of, say, 10x and higher are pricing in some growth expectations to add to the earnings yield. Stocks trading below 10x generally have very modest and sometimes no growth expectations at all. Now, thanks to the GNU and the lack of load shedding and everything else we've seen this year, there are now a lot of companies on the JSE trading above 10x. As many of the companies on the JSE are somewhat good quality businesses, and the market now thinks that they have decent prospects as well, thanks to a better South Africa, growth is being priced into these share prices more and more, and that's why the whole market has gone up in 2024. This means the pressure is on as we head into 2025, especially since earnings growth has not really started coming through yet for most companies. Now let's consider the example of a PE of, say, 7x. The earnings yield, that's the inverse, is 14.3%. You can just work that out by taking 100 divided by 7. Or 545 basis points above that risk-free rate of 8.85% that I quoted earlier. Now this is a far more appealing return, isn't it? 14.3%. That's a lot better. At a 40% payout ratio, it's also a dividend yield of 5.7%, so even the cash component is not too shabby. But what kind of stocks can you buy on these sort of single-digit PEs? In the sub-10x club, it's very much a tale of cyclicals and the forgotten few on the JSE. Right now, for example, you can buy the likes of Bell Equipment on a PE of 5, Kumba Iron Ore 5.6, Exxaro 4.7, Tungela 5.6. But what do you notice here? These are cyclical stocks, either directly engaged in mining activities or selling products to that industry in the case of Bell. Where we are in the cycle makes a huge difference to the PE. Interestingly, some of the old hands in the market will tell you that the time to be scared of mining stocks is when their PEs are low, as it means the earnings base is high and you may well be at the top of the cycle. Now, if you go a little bit higher when you are screening based on PEs, you'll find some pretty interesting names. Coronation 6.2, Cup 7.4, Grindrod 7.9. These are stocks where the market just isn't quite sure. Each company has unique challenges at the moment that call growth into question. If they could unlock a little bit of growth at least, it would be plausible for those valuations to move higher and for investors to get decent returns. But until the market feels confident of that growth, investors are not going to pay up for it with any conviction, and those PEs are stuck in the single digits. In the sub-10 club, you'll also find companies that may not be cyclical in quite the same way as mining, but which still depend on external factors like commodity prices in the agri-space. RCL Foods and Oceana 7.5 and 7.4x respectively, Astral Foods 9.6x, RFG Holdings at 9.8x. It's quite difficult for those food producers to really get a premium valuation because the market knows that things can go wrong in an instant and often for reasons way beyond their control. It's just a tough industry. There are other quality companies at this end of the market though, like Raubex at 9.5x and Lewis at 8. Both of these groups have competent management teams and strong track records, yet here they are languishing at single-digit PEs. This is exactly why Lewis has used a share buyback strategy with such great success, as they are only too happy to clear out the shareholder register at this valuation. Again, both businesses have a cyclical underpin, construction in the case of Raubex, and consumer discretionary spending in the case of Lewis. The banks, well, they are down here too, at least most of them. Standard Bank, ABSA and Nedbank are all currently between 8.8 and 9x, with Investec down at 7.7. FirstRand tends to trade in a class of its own, and Capitec is in a different postal code altogether. At this stage in the cycle, though, with interest rates coming down, the market is not paying a premium valuation for banks, or at least most of them, and nor should it, as recent updates have suggested mid-single-digit earnings growth for these banks down here. Once again, there's a cyclical element here, albeit related to interest rates. So the cycle may vary, but the concept is that down here in the sub-10s, it's mainly cyclical businesses. So this begs the question of what do you find in the over-20s club, where things are priced for perfection? Now, at the other end of the spectrum up there, we find the best companies on the local market, along with retailers that have seen a huge boost to their valuations this year, despite being consumer discretionary businesses. Investors love the recurring earnings of large retail groups, seeing them as a dependable way to achieve earnings growth above inflation. In practice, it doesn't always work out quite that successfully though, which is why I am dubious of all these retailers trading at north of a 20x PE, and there are many of them. There are also some exceptional companies that have long growth runways ahead of them. Capitec springs to mind, but it's trading at over 30 times earnings. Call me biased, but We Buy Cars is also a great business, and as mentioned earlier, if you look at the right earnings number, it's at just over 20. ShopRite might be a retailer, sure, but they just have so much market share to still win, and you'll find them up here as well, trading at almost 25x. Now just consider those earnings yields for a moment. At 25x PE, you're dealing with a 4% earnings yield. ShopRite is on a dividend yield of just 2.3%. The market is pricing in plenty of growth here. Double-digit growth or more, actually, just to make total returns look decent. The companies that keep on delivering this growth can also keep enjoying strong share price returns. But the companies that falter at this level can suffer a nasty multiple unwind that really ruins returns. One thing is for sure. Far more needs to go right at a 25 times PE than an 8 times PE. If you're playing at the very high quality end of the market, be very sure of the moat that you are buying into. There need to be excellent reasons why the growth can continue. Down in the single-digit PE club, you're really just hoping for growth in line with inflation and you're actually coming out okay, especially if there's also decent cash flow generation. These risks at the opposite ends of the market are simply not the same. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research and form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.